Hey, good morning, everyone. This is Mark from Right Line Trading, and I really appreciate you giving me your time this morning. And I just want to quickly start out with this disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers in the futures, forex, or stock markets, nor for any profits or losses that may be incurred. Participating in trading in the forex and futures markets does involve substantial risk, and it should be understood that a person can lose a substantial amount of money. Therefore, participation in these markets is not appropriate for everyone. Carefully consider your financial position prior to making a trade. You may want to do your own due diligence and consult a financial advisor. Those of us who are at Right Line Trading are not registered financial advisors and not licensed commodity trading advisors. With that said, just a little bit of my background. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia. I've published close to 15 peer-reviewed articles in first-tier journals, and I've been involved in the financial markets for over 20 years. Right Line Trading software is the product of over a decade of analysis of price action, market structure, and indicator algorithms. And the software is based on mathematical modeling. I consider myself to be a mathematician. I have a very strong background in math. And what we do is we look at each financial market as a closed system. We determine which forces move price in this closed system, we put each of those forces into a multivariable equation, and then we optimize that equation in order to be able to predict how price is going to move off the right edge of the chart. And we're one of the fastest growing trading systems on NinjaTrader. Now I'm going to skip a little bit ahead and just tell you that our system works on futures, forex, and stocks, and it works on any type of on any time frame and with any type of candle. So it works with time, tick, range, Renko. Although I'm going to be showing you the charts in Unirenko form, which I just happen to personally really like. Now, all indicators have forward-looking ability, and I'm going to show you exactly how we do that. No, they all lead price. None of them lag price. So the purpose of the software is to predict how price is going to move off to the future, or that most difficult place on the chart, which is always the right edge. That's where the pedal hits the metal, and that's where we have to know what's going to happen. And our software, with a great amount of precision, predicts exactly where that price is going to go. Now, personally, I like Unirenko. I'm not going to go into a lot of detail just because of time. But for a long time, I traded range bars. They actually trace out market structure really well. But I've switched to Unirenko. Now we use a Unirenko. It's unique to the system, and you won't find it anyplace else. And it shows a wick inside each Unirenko candle. So we can also see price action, market structure, even though we're trading with Unirenko candles. Now, the weaknesses of Unirenko is they do obliterate some price action. They don't tell you who's in control of the market on a candle-by-candle basis, bulls or bears, if you use the following: Japanese candlestick patterns. You can't see an engulfing candle, a dark cloud cover, a piercing candle, a doji. None of those patterns are going to appear. You cannot discern between a rising and falling triangle, or although you can see channels. What I want to do is appraise you of a completely different paradigm that's operating in the market very forcefully in the last decade. And that is the fact that institutional money is probably the single factor that drives price. And remember, the Japanese candlestick patterns were created over 400 years ago by Japanese rice traders and were operational in the stock market for many years, giving us market sentiment. If there was an engulfing candle, we knew that the traders in that engulfing candle were moving the market with a lot of force. But now that institutional money really controls the market and is responsible for 70% of total volume, Japanese candlestick patterns, in my personal opinion, simply don't work anymore. And if you're trying to trade with them, you're going to get run over a lot. And the reason is that when the Japanese rice traders, when Elliott Wave created his theory, when Gann theory did, even when Fibonacci did, they made a supposition, and that is that the power of every bear equals the power of every bull. Or to put it another way, the power of every buyer was equivalent to the power of every seller. It's because at that time, the market was made up of a constituency consisting of just small traders like us. But now the market is dominated by big money, by institutional money, and by bank money. And irrespective of what your candlestick patterns are showing you, irrespective of when you're in a falling triangle or a rising triangle. Now, these things have been around for, candlestick patterns, 400 years, falling triangles and rising triangles, channels, etc., have been around also for decades and decades. And still 95% of day traders fail. So if you're going to use all these old things that have been around forever, they're never going to make you profitable because they've never made anyone profitable in the past. And one of the problems with day trading and swing trading is that we don't learn from our mistakes. We continue to use the same trading methodology that has been used by the prior 95% of traders that have all pushed them off the cliff. And I believe it's even higher than 95%. I think it's closer to 96 or 97%. So with institutional money really in the driver's seat and running exactly the direction that the market's going to go, we have to change our trading methodology and eliminate this stuff. If we don't, we're going to wind up in the same boat as all the other traders have in the past. Now, the strength of Unorenco is they do filter out noise, and that's extremely important. We want to see when institutional money comes in to create a powerful trend. And if in addition we have leading indicators that signal an entry, they do create superior trading opportunities. Now, each market comes with an optimized input, whether you're trading Forex, futures, or stocks. And we give those all to you when we set you up on your computer. Now, I'm just going to skip these two slides. And I'm going to go to the core of our system. The core of the system is our three-line indicator. And these are three forces that we've defined mathematically that are responsible for how price moves off the right edge of the chart. One is momentum, one is stochastic, and one of the most powerful is order flow. I'm going to talk about order flow first, and I want to try to move as fast as I can so I can finish up. Now, order flow, the way we define it, uses, this is the volume ladder, and this is the market delta. And you can see this is a positive 29.85. Now, this looks at the number of traders at the bid and the number of traders at the ask. Totals them all up and tells you whether there are more traders looking to buy or more traders looking to sell. So you would assume that if there are more buyers on the dome, that there's buying pressure and the candle's going to close up. Now, these are stacked sellers and these are stacked buyers. And I've seen lots of webinars in which you're being proffered or order flow or volume ladder. But I'm going to show you why almost all that software does not work. And it's based on this. Here's a positive market delta off this volume ladder, and the candle closes to the downside, even though the market delta is positive. And there's a really easy explanation for this. Even though there's a preponderance of buyers, just excuse me for 1 second. I'm drinking my orange juice, actually my Diet Coke. Even though there's a preponderance of buyers here, the sellers are more aggressive. So let's say the stock is at 50. The buyers are only willing to buy it at $50.01, but the sellers are willing to acquire it at 49.9 cents, 49.8 cents, even maybe 49.7 cents. So they're much more aggressive than the buyers. So even with a positive delta, you get a down candle. So what's the problem? So what do you do with market delta? Because here's the issue. If you use a standard volume ladder and standard market delta analysis, you're going to wind up with about 1/3 of your candles, or one standard deviation's worth of data is going to work, but you're going to get outliers in which the market delta value is wrong. See, there's the up candle closing with a negative delta. There's a positive delta on a down candle. Here's a positive delta on a down candle. So if you look at the volume ladder and you do order flow analysis, and you just base it off your trading chart on a chart that looks like this, which shows the absolute value of the market delta values, you're going to wind up getting stopped out a lot, because you're going to wind up with a positive delta on a down candle or a negative delta on an up candle. So if one standard deviation's worth of data works, then you know that there's power in the analysis. You just have to have a way of filtering out the outliers. And here's how we do it. What we do is we look at the 2 higher time frame trading charts. None of our analysis is done off of your trading chart. If you pull in data from your trading chart, you're turning an independent variable or an independent assessment and making it a dependent assessment. It is imperative that we do not care what's going on our trading chart, and we let the 2 higher time frames rule for every assessment we make. And if we don't do that, our analysis is going to be confounded and it's going to be inaccurate, because the trading chart is always going to follow whatever analysis comes off the 2 higher time frame charts. Now, my mentor was named Alexander Elder, and he wrote a book in 1997 when there was very, very primitive charting called the triple screen method of trading. And this is exactly what he did. And Alexander Elder became a multi-millionaire day trading and swing trading in an era when there was very, very primitive charting, because he looked at three charts at the same time and waited for his two higher time frames to align, and he used very primitive indicators. And when they did align, that's when he took a trade. We do the same thing, but we make it really easy. So if you're trading a 2-minute, the assessment's going to be done off a 6-minute and an 18-minute. If you're trading a 5 range, it's going to look at the two higher fib numbers, an 8 range and a 13 range. If you're trading a 377 tick, it's going to look at the 610 tick and then the next higher fib number. That's how the coding is built into the indicator. So automatically default, it looks at the speed of your trading chart and defaults to the two higher time frames and does its analysis off the two higher time frames only. So what we do with order flow, which is the most complex assessment, is we put each market delta value that appears above each candle on the two higher time frames into two 15-period simple moving averages. So that smooths out the data. So when you get an outlier, it doesn't really change the slope of this SMA, because this SMA is really powered by that one standard deviation's worth of data, which is correct and tells you who's in control of the market, the bulls or the bears. So when both of these 15-period SMAs are sloping up, the bulls are firmly in control of the market. And our order flow assessment line, created off the two higher time frames on these two 15-period SMAs, is going to be green. And when both 15-period SMAs are sloping down, we know that the bears are firmly in control. The order flow assessment line is red, and we can only trade short. And when the 15-period SMAs are not in agreement, we know that the line's going to be yellow, and that's going to be one of the ways that we define chop. Now, defining chop is critical. And when I ask traders in my trading room, what is the most important goal of a trader? Whether you day trade or swing trade or do any kind of trading, it's not to get winners. It's to avoid trading losers. Anybody can get winners. I have a son here who could sit in front of my computer and probably wind up getting a lot of winners. The problem is that he's going to pull in a ton of losers. And that's probably, if you're sitting in this audience, that's probably your issue, is that every day you get winners, but you also pull in too many losers. So what you're looking to do is to trade with a great amount of specificity. And that is only trade when everything aligns in your direction, so that you can filter out the losers and still get you. If you do that, you're going to get plenty of winners to become profitable on a very, very consistent basis. Now, here's the assessment. Now, you can see, now this is the order flow line off the two higher time frames. It's not looking at price, this price. Now, I purposely pulled out the size of the Unirenko candle, and I pulled out the instrument because the assessment is time independent and instrument independent. It doesn't matter what time frame you're trading, and it doesn't matter what instrument you're trading. So no matter what this is looking at, what this is looking at is essentially irrelevant. So you can see that order flow is going to lead price because it comes off the higher time frames. And I'm going to show you that on a live chart. So you can see that price is going to turn up after the order flow line turns green. And we have an absolute direction to trade. If you try to counter trend trade, you're going to get stopped out. And you can only trade long. And here you can only trade short. Now, there are a few other rules that I have to define in terms of market structure. But essentially, you can only trade in the direction that order flow points to, or you're going to take a very, very high risk trade. And the one thing that you want to avoid, like you're the plague, like you're allergic to it, is taking any trade that has any kind of associated risk. You want to take the lowest risk trades possible, and they are in the direction of order flow. If you see this trader caught in this down candle, there's no way that trade's going to be successful. Now, what are they using to create this down candle? Possibly MACD divergence or stochastic divergence. Divergence in a market in today's environment does not work because there's no mathematical way to call a top or a bottom. A top and a bottom are called by institutional money only. And this is really a proxy for institutional money. The only thing that can create this kind of buying pressure is big institutional money. So when institutional money is done buying, that's when the market hits a top. Can we determine that mathematically? Never. If you're trying to call tops and trying to call bottoms, or you're chasing software that tells you that you can, you're really going to get taken to the woodshed. The only thing you can do is get in early here, right before price starts to move up in the direction of big money, which is going to give you an absolute direction to trade. Here's another example. Price is going to turn after the order flow line turns, and up we go. Again, in the counter trend direction, trying to trade against the direction of order flow, these traders are going nowhere. And maybe that's you now. You're calling a top, you're trying to counter trend trade. Some type of system is telling you, you've hit resistance, a double top, whatever it is. You're trying to counter trend trade, but as long as big money is still in the market, creating this kind of buying pressure, you're going to get beaten up. Now, this is another example, and I'm just going to go past it. Now, when the order flow line continually changes color, it really helps us define chop and tells us when to stand aside and not trade. Because I'm to give it to you mathematically, sensitivity over specificity times prevalence equals your win percentage or positive predictive value. So the bottom line is the prevalence of getting a winner is greatest in a trending market. You don't want to take a trade when the market's chopping. We all know that. But it's also defined mathematically. So you only want to take a trade when the market's trending. Now, it's tougher to see when there's only one line. But we're going to add momentum. Now, the momentum line is assessed off the MACD, or the slope of the MACD. When the MACD line is accelerating away from the signal line, momentum is moving to the upside. And when the MACD line is accelerating towards the signal line, then momentum is to the downside. Now, there were a lot of ways we could have assessed momentum. We could have done it with an oscillator. We could have done it with Heikin-Ashi. A momentum is accurately assessed by a number of indicators. I personally like the MACD the best because you have that MACD crossover. And although I'm not going to talk about it in this webinar because it's a little bit too complicated to go into, the momentum assessment takes into account this cross it's a major event for some. For me, it's not. I'm just looking at this at whether we've got the MACD line accelerating away or towards the signal line. And remember, we're only doing the assessment on the higher time frames. We're eliminating any MACD assessment off our trading chart. And if we throw the assessment of our trading chart in, it's going to ruin the overall assessment. All we want to know is what's going on our higher time frames. And we do the same thing. We look at the two higher time frame charts. You know, I did this for two higher multiple because I was looking at Renko. But again, time, tick, range, Renko, we're going to be looking at the two higher multiples. And they're either the two higher fib numbers. If you're not trading an exact fib number, it will default to the closest fib and then take the two higher fibs. Whatever time you're trading, if it's a 2, it's going to look at a 6, and it's going to look at an 18. If it's a 3-minute, it's going to look at 3 times. It's going to look at the 3 times your trading chart and then 3 times again. So it's looking at the higher multiple time frames. Now, this should be when both MACD lines are accelerating away from the signal line, our momentum line is green. And when both MACD lines are accelerating towards the signal line, it's red. And when the MACD lines are not in agreement, you get a yellow line. So now we've got two forces that move price that must be in alignment on our trading chart in order to take a trade. So now it's even easier to define the direction, and it's even easier to define chop. Because when you don't have green, green, or you don't have red, red, you can't take a trade. And again, the indicator analysis is going to lead price. Price is going to rise, and then the first down pivot, when you get red, red, is going to give you your down trade. And your first up pivot, when you've got green, green, is going to define your long trade. And if you trade against these two forces, the probability of getting stopped out is extremely high. Here's another example. Now it's easier to define chop. At a pivot, you have to have green, green, or red, red. And so it's easier to see here that you just don't have an entry. Here, when you got two reds, price, it's going to lead price, and price, it must trade short. Here long, here short, and here long. If you try to trade against these forces, again, the probability of being stopped out is high. And remember, the only thing that can create a momentum and order flow assessment in the manner that I've showed you on the two higher time frames, create this kind of alignment, is solely big money. Small traders like us cannot do this. We tend to create chop because we all fight against each other. When the big institutional money comes in and drives the market down or drives the market up, that's what, excuse me. I just came back from a week in Colorado skiing. I'm really sorry, it's like 1 degree, and I got a little bit of a cold. So we don't care about Japanese candlestick patterns. We don't care about rising or falling triangles. We don't care about calling a top or calling a bottom. All we care about is trading in the direction of institutional money. It's not what most mentors teach you. But remember, what's being taught right now is sending 95% of traders off the cliff and blowing their accounts time after time. So you've really got to put aside almost all the stuff that's out there because most of it is not working. The other thing is when institutional money stays in the game and it drives order flow and momentum and they stay green, you can ride price for a very long time. And you can see that nobody in this move even tried to take a counter trend trade because big money just zapped price up on huge volume in a big move. So if you want to also get the grand slam trades, I mean, a single or a double or a triple is still a terrific trade. But if you really want to get those huge home run trades, you can get them as long as institutional money continues to buy. We're not going to try to call a top here until institutional money steps aside. Again, now it's easier to define chop, where we definitely do not want to trade. And there's red, red. And even though we have these up candles, we're not trading them. We're only trading the down. These up candles are created by the small trader like us trying to counter trend trade against the direction of big money. They can pull it off for 2 or 3 or 4 candles, but eventually the trade is going to fail. Now, the last assessment is stochastic. Now, stochastic also is a little more of an elegant assessment that I'm going to describe. I'm just describing the nuts and bolts of the assessment. And what we do is when a line is overbought or oversold, we don't look for divergence and we don't look to fade the market. When when the stochastic line is greater than 80, we believe that's institutional money creating a tremendous amount of buying pressure. So that's going to cause our stochastic assessment to be green. And it has to be on both higher time frame charts. When the stochastic line is red, will be red when it's below 20 on both our higher time frames, because big money has squished this bounded indicator below the 20 line and held it down there. So big money has its foot on price and is selling it hard, and we're going to go with big money. Now, when it's between 20 and 80, it's simply a matter of whether the stochastic line is above the signal line or the stochastic line is below the signal line. If it's above the signal line, the stochastic assessment is green. If it's below, the stochastic signal line is red. And when both stochastic lines are not in agreement, then the line is yellow. So now we have 3 lines. But what we want to do is make it easier for you to trade. So what we do is this. When all 3 lines are in place, the assessment does become a little bit confusing. Because remember, every color of all 3 lines is changing intra-candle. These are all intra-candle assessments. And you want to focus on price. You don't want to focus on those 3 lines that are potentially changing color below you. So what we do is we project the results of the 3 line directly onto the candle halo, making the assessment really easy, and you're not having to look at the 3 line at all. So the assessment is projected right onto the candle halo. And what I do is I make the whole 3 line invisible because it's just, just hold on 1 second. I'm sorry. Hold on 1 second. I'm sorry. So here's what we do. Now, first, when the candle is haloed in blue, it means that order flow, stochastic, and momentum are aligned to the upside on our two higher time frames. When the candle is haloed in red, it means that that order flow, stochastic, and momentum are aligned to the downside on our two higher time frames. I'm giving this webinar from my house, and of course, everyone knocks on my front door. So if we look here, you can see that this candle halo on this up candle is yellow. And that means that order flow, stochastic, and momentum are aligned to the downside. And this up move is pretty much doomed. The next down candle, see, this down candle was haloed in black. So there's no trade. This next down candle is haloed in yellow, which tells you the market is going to roll. We have an up move candle haloed in yellow. On an up candle, it's telling you that order flow, stochastic, and momentum are aligned to the downside. The next candle pivot, down we go. These traders caught in this up candle are going nowhere because order flow, stochastic, and momentum, you can see, is locked red. And the next roll to the downside is your entry. Now, this is what I was saying, is that the workspace should be as clean as possible. And we don't even need to project, excuse me, all my son's friends walk in here. Give me 1 second. The terrors of giving a lecture from your house, not from your office. So what we do is I remove the whole three-line assessment. And the only thing that we have to look at is the candle halo. So now we have no more three-line because the three-line assessment is projected onto the candle halo. And you can see on the move up, the down candles haloed in blue, the move up we go. Now, we're not going to take the short trade, and I'll show you why in a couple of minutes. We're only looking for long trades. Here, up we go. Now, we're not going to take the short trade because it's a counter trend trade. And when I add market structure to the chart, you'll see why the only direction we can trade is long, and we're looking for the go signal from the three line. Again, same thing. Here's our short trade. This really is no entry. There's no entry here. The candle's haloed in black. There's no entry. The candle's haloed in black. And the two real juicy trades are the two short trades in the direction of order flow, stochastic, and momentum. Now we add an exponential oscillator. And the exponential oscillator is not absolutely required for us to give us a signal, but a signal does decrease risk. The reason we made it an exponential oscillator is because we took the oscillator formula, multiplied it by 2 to make it very fast. Now, if we get an entry, you can see this triangle where the oscillator line or the %K line crosses this 50 magenta line, that's going to give us an up. And when this magenta line crosses the 50 line, we're going to get it down. And we get it down, and we get it up. Now, These are oversold lines that have been removed, subsequently removed from the assessment, so we don't look at these. Now, if we have the 3-line with us, we have a long. If we have the 3-line with us, we have a short. Now here we have no trade because the triangle must come either on the first candle of the pivot or the second. If it comes on the third or the fourth, there's no trade. Here we have a perfect down trade. So the exponential oscillator has a really great track record for calling an entry as long as the 3-line is with us on the trade. So one of our rules, now we're defining market structure, is this is a 50-period simple moving average. And when price is above the 50, we only go long. When price is below the 50, we only trade short. So the only thing that we can do is trade long when we're above the 50 and the 50 is green and sloping up. So here's an oscillator entry, candles haloed in blue, up we go. Blue, oscillator entry, up we go. Blue, oscillator entry, up we go. Blue, oscillator entry, up we go. Now it's no accident that the tighter to the 50 you trade, the longer the move is likely to be. The closer to mean price you are, the more likely you are to get a big move. And we take this into account when we trade. That's another trading rule that I would go into in a master class that you're going to get if you come aboard, is that we want to trade tight to mean price. This is fairly close and we get a nice move. Price here is lifted off the 50 and we get a shorter move. Price here is lifted even further off the 50 and we get a shorter move. Here, price is right on the 50 and we get a beautiful long move. But always in the direction of order flow, stochastic, and momentum. And the system gives us a great long entry with the oscillator signal. Now, this is a little bit of a sloppy chart, but you can see short, 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 and short, all with oscillator signals. And we don't counter trend trade. We never go long below the 50. We only go short below the 50. This oscillator long worked with order flow. This oscillator long worked with order flow. But we just don't counter trend trade. That's one of our rules. We're looking to avoid risk. And even though a lot of these trades are successful, too many of them don't work. And we don't want to pull in any losers. And here's what happens when you get a long sustained move when big institutional money comes in. You get a perfect oscillator entry. You can ride this market all the way up. This is a 20 Unirenko candle. Each of these is either 20 cents or 20 ticks or 20 pips. It doesn't matter whether you're trading stocks, futures, or Forex. You're going to get a long, sustained move to the upside. Your first exit is this magenta halo. You lose the alignment of order flow, stochastic, and momentum. That's your out candle. Here's your move to the downside. It's sustained. You can see that you have order flow, stochastic, and momentum aligned to the downside. Candle halo, you're below the 50. 50 is red, 15 is red. Here you get a neutral assessment. As I had mentioned to you that the assessment's a little more complex than I'm letting on. But once it turns against you, there's your out candle. So you get the majority of the move all the way down. The highlight in blue takes you right out of the trade. Now, I wanted to show just the Euro USD, and this is the same system. This is a 90 pip move. Here's your, let me find the entry. Your entry could be anywhere right off support, as long as you have order flow, stochastic, and momentum with you. And you'll notice in this whole move up here, order flow, stochastic, and momentum have never turned against you. Everything is highlighted in blue or neutral. So once you get into the trade, you're then going to stay in the trade until you get a reversal candle or a candle that's highlighted in magenta. Here's another trade, 21 pips on the Forex. Now, before I get to the offer, I want to do two things. I want to do them really quickly. Let me see how much I have, 10 minutes. With all these interruptions, it's driven me a little crazy. I'm sorry about that. And I want to, while Ninja Trader's booting, I want to show you a little video. Now I'm going to move it to here. Now, one of the trades that we take, excuse me for 1 second. Okay, now, let me move it further. Now, one of the trades we take is a pivot break with order flow, stochastic, and momentum in our favor. And I'm going to talk about the green background bias and all the other things in a minute. And I hope I'm not confusing you by throwing too much information at you. But you've got a lot of sellers in this pivot. When you break the pivot, which is a 2/3 candle body close above, you're going to start stopping out all the sellers in this pivot, and it's going to propel the trade higher. As long as you have the 3-line with you on the trade. Hang on. I'm closing it up. I'm folding up, but we're just going to watch for a minute.
Order filled.
Now, there's the order. It's filled. Now, the targets are set by the system. We configure them. Here we go.
Target filled. Target filled.
And the trade's over. And that's a $500 trade right there. On the break of the pivot, with order flow, stochastic, and momentum, you stop out all the sellers who are in this pivot, and you see how the trade fired up. Now, let me show you the workspace. Now, I have it configured on the E-mini, crude, gold, the YM, the Russell, the 6E, and the NQ. Now, background bias is extremely important, and I haven't mentioned it. And there are a couple of things I want to mention. I only have 7 minutes left. And I'm really sorry. I mean, my son brought like I don't know, 6 or 7 friends over here. And if you have a teenager at home, you can maybe empathize. But we're only looking at the candle halo, because that's all that's important. And what we're going to do is only trade when we have pink background. That's when we have a multi-time frame alignment and trend of our trading instrument to the downside. And this is the most powerful downtrend that we have, is right here. And we're looking for a pivot break and a move down. We can also take a pullback. Any pullback in a confirmed trend is an entry. There are 3 entries, and I'm going to show you all of those in the master class. I do not trade when there's no background, because that means there is no multi-time frame alignment and trend. We don't trade here into support. So here's a trade. It's not a big one, but you see on this down candle how it's highlighted in blue and it goes nowhere. It prevents you from taking a loser. And that's what we want. We do not want to take trades and walk into losers. And the 3 line is really powerful for doing that. Well, here's crude. And like I said, it doesn't matter whether I'm looking at a stock or a future or the Forex market. We're looking for the pink. This is a very small move down. I'm just looking for an entry. See, and here's your beautiful entry. There's the pivot break, and there's your move. Now, you're probably going to get out on this candle, on the up candle. There's the break in the direction of order flow, stochastic, and momentum, and your move down with dark pink background. Now, there's 2 kinds of pivots. We never trade into them. Now, the pivots that you see in general are created off of candle wicks. These small lines are created off of candle bodies. That's where pivots should be. These thicker lines are areas of buy-sell imbalance created off of the higher time frames. This tells us that there's a preponderance of buyers here, and we never trade into it. So we've got 2 types of support and resistance. We've got a pivot that's created off the chart, and we've got a multi-time frame assessment of buy-sell imbalance, in which right here there is a preponderance of buyers. Now, in this particular case, it broke. But we never trade into that either. We wait for the break. We can take a look at gold. Right here on the break. And the move up. Here we have no trade, no alignment. We don't only trade the dark pink. Now here we miss it by a candle for a nice down move. I'm just looking for that primo color to trade. Right here. Up we go. Pivot break, and down we go. Now you're going to get very, very few losers. See this pivot break? No 3 line. That's another loser that's prevented from being taken. This pivot break, full winner. So that's the system. That's formatted. I showed you one on Minute, and I showed you one on Unorenco. So let me bring back the slides. and show you the offer real quickly. Let me find them. Here they are. And I do want to get to questions. Let me see if I have 1 second for questions. So I'm going to show you the offer pretty quickly. Now, hang on a sec here.
Hey, Mark, yeah, we're about out of time. So yeah, if you want to just talk about the offer real quick and then.
Fair enough. Now, you get the Trend 3 software. You also get my Perfect Options module. And that's a 12-hour digital class. It's 6 parts that shows you exactly how I trade options using the system. You're also going to get a rapid results quick start guide that'll get the system up and running for you in 15 minutes. If you can't do it, we will do it for you. We will do a white glove installation. And I'll just skip that. You're going to get free lifetime updates. Anytime you make the software better, you're going to get that improvement, no charge. We're always here to support you. You're never going to get voicemail. And then you're going to get my options alert newsletter, where those are the options trades. You get a year. These are the options trades that I take in my own live portfolio. In 2017, we made 115%. 2018, we made 107%. This year, I haven't calculated it yet, but we've done real well. You're going to get a year of those calls. I'm going to skip that. That's actually how much money you would have made if you started. You'd be up over $22,000 if you started with 5. Now, here's the system. It's $697 for a lifetime license, free upgrades for life. Bonus 1 is the options masterclass. Bonus 2 is the quick start guide. Bonus 3 are the free updates for life. And the first 10 traders get 1 year of my options alert newsletter and 1 year of my elite trading newsletter. And just let me show you real quickly. These are the closed positions. I only started it 4 months ago. I work with 4 professors at the University of Miami School of Medicine. We pick the small cap biotech stocks that are most likely to get FDA approval for their phase 1, or for their phase 2 or phase 3 drug trials. I have yet to take a losing trade. Soleno, I made 22. Cura Oncology, 26%. Mymex, 34%. Fomix, 19%. Clearside, 114%. Unicor, 17%. Cytidine, 66%. Intracellular Therapeutics, 340%. And I just picked Nectar at 20. It closed on Friday at 26. I put in 25 when I did this slide, and it still hasn't had its catalyst. So I do a lot of work with 4 professors of medicine at the University of Miami. We pick the best micro cap or small cap biotech that's going to fly on a phase 2 or phase 3 drug approval. And we so far have a 100% track record. So here's the offer again. The first 10 traders get these 2 alerts. You can call us right now at 786-732-4656 if you're interested. And the offer expires Monday. And eventually we'll be sending you a link to purchase if you like. I'm sorry I can't answer any questions. If you do have any questions, just call this number right now. And Rory is standing by. I'll be more than happy to answer any questions that you have. I really appreciate you for having me and putting up with all these interruptions I had. It's always the case that my son will always bring over a ton of friends right during a webinar. So listen, have a really, really wonderful weekend. And I look forward to talking to you when you come on board. Take care and have a great, great week.